What happened to silver yesterday was not a normal price move. A 10% surge in a single session is not noise, not speculation, and not retail excitement alone. Moves of that magnitude only happen when pressure inside the system breaks containment. Silver is now trading near $79 per ounce in U.S. markets, while reported pricing and transactions tied to Asian demand, particularly China, are occurring at meaningfully higher levels, closer to the mid-80s per ounce. That divergence matters more than the headline price itself, because it suggests silver is no longer being discovered in one unified global market. It is being repriced region by region, depending on physical demand, capital controls, and willingness to deliver metal rather than settle in cash. This is where most people misunderstand silver. They think price comes first, demand second. In reality, demand breaks the system first, price follows later. When price jumps 10% in one day, it's rarely because buyers suddenly became emotional. It's because sellers disappeared, liquidity vanished, offers were pulled. Someone needed metal or needed to exit a short exposure, and there wasn't enough available at the quoted price. That's why silver behaves differently from equities or cryptocurrencies. Silver is both a monetary asset and an industrial input, which means stress shows up physically before it shows up on a screen. Now consider what happens next. The COMEX has announced an upcoming margin increase on silver futures, around 13%, effective Monday, reportedly to cool volatility. This is not a neutral action. Margin hikes are not about fundamentals. They are about controlling participation. When margins rise, leveraged traders are forced to either post more capital immediately or liquidate positions. That creates selling pressure, regardless of conviction. But here's the problem. Margin hikes work best when a rally is speculative. They work poorly when a rally is driven by physical scarcity and delivery risk. You can flush paper longs out of the market, but you cannot force physical holders to sell metal they don't want to part with. And this raises a critical question. Can the COMEX handle a sustained flood of new silver orders if physical demand continues to accelerate? Futures markets rely on confidence that contracts can be rolled, offset, or settled without strain. But if too many participants demand delivery, or if too many shorts scramble to hedge exposure, the system tightens rapidly. This is why attention is turning to the LBMA as well. London is the center of wholesale silver clearing. If global prices converge toward higher physical benchmarks, the LBMA faces a choice: reprice to reality or risk credibility erosion. Markets don't collapse because prices rise. They collapse when trust disappears. This is also why yesterday's move caught mainstream attention. And when silver price action breaks out of specialist circles and into public conversation, behavior changes. People who never cared about silver begin asking why it's moving faster than gold, faster than stocks, faster than most commodities. They don't need to understand futures mechanics. They just see momentum and instability elsewhere. That's how demand broadens. And once demand broadens, it becomes far harder to contain. If you're still watching at this point, subscribe and stay with this analysis to the end, because what comes next explains why attempts to slow silver rallies often make them more dangerous, not less. Drop your thoughts in the comments as well. Do you think this move is just the beginning of repricing or a final blow-off attempt to regain control? To understand why silver may be entering a repricing phase, you have to understand how silver has been priced for decades. Silver futures represent many multiples of the physical metal available for immediate delivery. This leverage works as long as most participants treat contracts as financial instruments rather than claims on metal. But when price accelerates rapidly and confidence erodes, incentives change. Suddenly, holding paper exposure feels riskier than holding physical silver. That's when futures markets become fragile. Reports circulating about bank exposure to silver short positions and emergency liquidity measures to stabilize balance sheets are not shocking in this context. When institutions carry large directional exposure in thin markets, sudden repricing creates collateral stress. Whether bailouts are labeled as support facilities, liquidity operations, or temporary funding, the effect is the same. Systemic risk is being managed, not eliminated. And when central banks step in to stabilize banks while silver prices surge, it reinforces a powerful message. Paper systems need support. Physical assets do not. Now add the social and narrative layer. Elon Musk posting about silver, especially expressing concern about rising prices, matters not because of endorsement, but because of visibility. When influential figures comment on silver at moments of volatility, it amplifies attention. Attention brings scrutiny. Scrutiny brings demand, and demand stresses supply. Silver does not need cheerleaders to rise. It only needs buyers who refuse to sell. This is where talk of parabolic price action enters the conversation. Parabolic moves are not driven by optimism. They are driven by short covering, liquidity gaps, and fear of non-delivery. If silver moves from $79 toward $85 and above without meaningful pullbacks, the market enters a reflexive loop. Higher prices force shorts to cover. Covering pushes prices higher. Higher prices attract new buyers. New buyers reduce available supply. That loop continues until either demand is destroyed by price or the system intervenes more aggressively. Can margin hikes stop that loop? Temporarily, maybe. Permanently, no. Margin hikes reduce participation, but they also reduce liquidity. Reduced liquidity increases volatility. Increased volatility makes hedging harder, and harder hedging raises the cost of maintaining short positions. That's why repeated attempts to suppress silver historically lead to larger, faster breakouts later. Suppression doesn't cancel demand. It compresses it. Now consider the global context. Industrial demand for silver is not discretionary. Solar panels, electronics, defense systems, and advanced manufacturing all require silver. These buyers don't care about COMEX margins. They care about securing supply. If silver is trading higher in Asia than in the US, metal will move toward the higher bid until restrictions or frictions intervene. That's how arbitrage works, unless arbitrage is blocked. And when arbitrage is blocked, price discovery fractures. This is why some analysts are openly discussing scenarios where silver could move far faster than expected, $100, even higher, if confidence in paper pricing erodes quickly. These are not predictions, they are stress outcomes. They depend on how aggressively control mechanisms are applied and how strongly physical buyers respond. The key point is this: silver does not need everyone to believe in higher prices. It only needs enough participants to stop selling. So where does that leave us now? Silver is at a crossroads between containment and repricing. Containment relies on confidence in exchanges, settlement systems, and regulatory tools. Repricing happens when those tools no longer align paper prices with physical reality. The next few weeks are critical, not because of any single price level, but because of behavior. Watch how silver responds to margin hikes. Watch whether pullbacks attract buyers or trigger panic selling. Watch premiums, delivery times, and availability, not just charts. The idea that the world is running out of silver is often misunderstood. It doesn't mean silver disappears entirely. It means available, investable, deliverable silver becomes scarce at prevailing prices. That's enough to cause violent repricing. Markets don't need absolute shortages to break, only relative ones. And silver's unique structure makes it vulnerable to exactly that kind of stress. Will anything stop silver at this point? Possibly. Severe demand destruction, aggressive regulatory intervention, or a sudden collapse in industrial usage could slow things down. But those are not small events. They are systemic shocks. Short of that, volatility is likely to remain elevated. Silver doesn't move smoothly in bull markets. It moves in surges and pauses, shaking confidence before resuming higher. This is why education matters more than prediction. If you understand how margin hikes work, how futures leverage functions, and why physical demand drives long-term pricing, you're less likely to be shaken out by volatility. Silver doesn't reward emotional reactions. It rewards understanding of structure. Now I'll leave the final question with you. Do you believe silver is being repriced in real time, or do you think control mechanisms will regain dominance? Can exchanges slow this move, or are they simply delaying a larger reset? Where do you think silver price is headed from here? Leave your thoughts in the comments, and stay subscribed if you want clear, mechanism-based analysis instead of noise.